Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you, as always, for giving us a few minutes of your week where we discuss the week's investment points that we covered in Monday's allocation meeting. For this being the first Market Carver in March. This week, we're going to talk about four things. Well, we're going to talk a couple of economic points, and then we're going to move to market technicals. We're going to talk about money supply and some really significant changes there. We're going to look at more inflation data coming in hot. And then Andrew's going to pick up and talk about mega cap stocks and the difference between small caps and large caps and which way we're trying to lean at this point in time. So let's start off with the money supply declines. So I'm going to toss up here a chart of M2. So M2, many of you may remember from an economics class if you happen to take one in high school or college. I'm sure you discussed M2. And before we get to that, the reason it's important is that we're forever trying to capture and measure the supply of money. Why is that? I think mostly and chiefly it is to get a sense of where inflation is going. The most classic definition of inflation is too much money chasing too few goods and services. However, the difficult part of that equation is just coming up with how do we measure too much money? M2 is really the most widely used piece of that. Now, I think there are challenges with that, and that's just in what comprises M2, which is the amount of currency in circulation. So if you open your wallet and count all the actual dollar bills and the coins, that's the actual currency in circulation, plus the amount in your checking account and savings accounts. Those three together are going to wind up being M2. And if we look at this chart on the right tail end of it, you can see it shoot straight up. And that is through February of 21. That is year over year growth in the money supply. So it should make sense. That's really where you see it accelerate, which is simply all of the money that had to be created to help fund the COVID methods which we fought that battle. So money supply really surged. And what we've seen since then is inflationary measures. Inflationary stay high across the board. It's stayed firm. I think there's a lot more to this picture, but in a nutshell, I think it tells a good story, at least one reason why we've seen that. What we've seen, however, the last several months is a dramatic decline in the growth rate of the money supply. And then the most recent reading is actually an outright decline. Up to this point, we've seen slower and slower and slower rates of growth in the money supply, but now we've seen it outright decline, something that we have not seen since the Great Depression. So the first things first, it is from an extraordinarily large base, all that money created during the COVID era, still out there, and it's just beginning to come down. But the way it's trending is to the downside. So that's not an immediate positive for inflation. But if you look down the road 6, 12, 18 months, this certainly does lend itself to more alleviating that inflationary issue that we have in this country, which is our second point, and just another reading, another way of looking at inflation, which stays elevated. Something that as we come into the first couple of months of the year, there was really a very significant rally in bonds as interest rates across the board had come down, and really the thought that inflation was going to drop right back to 2%. As it's become more clear that that hasn't happened, interest rates have moved back up. The expectation for more Fed rates has moved up. And basically the entire year-to-date gains, those big gains that we saw in the bond market, have been given up. And here's another reason why. This is the personal consumption expenditures. It is widely to believe to be the most preferred measure by the Federal Reserve. So seeing this come in really strong on Friday was put a lot of extra pressure on those rates and expectations for the Fed. In fact, it has made at least a discussion that they will tick back up. We had seen them work from 0.5 rate hikes to 0.25, and the possibility now that they might go back to 0.5. Still not very likely. It's very likely that they stick with the 0.25, but this made it at least on the table that they could go that aggressive. We shall see when they convene here in a few weeks, but it would be an absolute stunner of this data if they showed any sort of indication of slowing down the rate hike. So that's inflation, Andrew. We'll pivot now to you. and share with us some of your thoughts on mega caps and small caps and where we're going from here.
Thanks, Alan. That was a good look at some of the inflation data and looking at the economic side. Now we're going to shift focus and start looking back to the stock market. So one of the topics that we often discuss is looking at the different asset sizes of the stock market. We often talk about the Dow Jones, the S&P 500. Those are largely those mega big companies, the biggest companies in the world. But we often focus on how the performance of small cap stocks or mid cap stocks. There's much more to the market than just the Apples, Amazon, Facebooks, Googles of the world. And the first chart we want to show here, we'll put that up on the screen now, is looking at those mega cap stocks first. So the primary driver, because they're so large and they account for such a large percent of the total stock market in the US, are some of these mega caps. The household names, again, of Apple, Amazon, Google, and Microsoft. We want to know how these mega caps are performing, because when they start to really trend in either direction, that's going to have a big impact on the overall trend of the market. And so unfortunately, what we're seeing here is we have the charts, the daily charts of each one plotted, and then along with them, the 200-day moving average. This is a commonly used tool to smooth out the price, and often will tell us if a stock or a market is in an uptrend or a downtrend, whether it's trading above or below this long-term average. So as we can see, we saw the market's been trending lower throughout 2022 for a lot of these stocks. And then we started seeing these bounces. We saw Apple, Microsoft, we saw Google, we saw them all start to bounce and get back to that 200-day moving average. Unfortunately, those are starting to fail now. We're seeing Microsoft back below, Google back below, Amazon unable to even get that breakout. And now it's just leaving Apple at the end of last week just $1 above that long-term moving average. So this is discouraging, as we saw stocks really get a nice bounce since last October. The broad market's given back about a third of that as we start seeing some weakness in February. And these mega cap stocks, again, are starting to roll over, which is pretty discouraging. Now, I won't leave you on that sour note. There is some bright spots here, and that's when we start looking at some of the smaller cap stocks. This next chart I'm going to show you is looking at the relative performance of small cap stocks versus large cap stocks. So when this line is going higher, that tells us that smaller capitalized stocks are leading large caps. And when that line is declining, as it was in 2021, that means the large caps are showing stronger performance. And so here we have recently, since the first quarter of last year, we started seeing small caps really start to rally higher. A big part of the reason for that was a lot of the biggest sell-offs, the biggest weakness in equities last year was some of the biggest companies in the world. We're seeing really, really large declines, whereas a lot of the smaller caps maybe were going down as well, but not as much. And so we started seeing relative performance there in small cap land. And so that's really where we continue to put our focus. And we started shifting our focus last year, at the end of last year, and we continue to this year, saying that we might be able to find opportunities outside of those household names, those mega cap stocks, and look for opportunities in smaller capitalized companies. And broadly speaking, the Russell 2000, the S&P 600, these other broad indices that may provide good relative performance in a market that may be challenging for large caps. So we think this is a trend that could continue this year, and it's something we continue to monitor very closely and adjust portfolios and the models accordingly. But right now, we're continuing to see a lot of strength show up in small caps, and that's really interesting to us.
Yeah, absolutely interesting. And especially now, this is, I hate to age myself exactly, but over 20 years in the business. And so I've seen a few of these different large cap versus small cap cycles, and it's just been interesting of how long they can be. Many, many years in a row, you can have a large or a small cap dominance. Don't really know why that is. It just has been. And so it's very interesting to see that turn. And quite honestly, I hope it continues, just because there's so many more small cap stocks, and it's a better pond to fish in my opinion. So would love to see that continue. So thank you, Andrew, and thank you all of you for giving us your time. As always, don't forget, come in and see us if you think we may be of service. Schedule your complimentary next steps meetings. Whether we decide to partner together or not, we will give you some things to think about. And of course, if we do currently have the pleasure of serving you, we'll look forward to seeing you in your annual update, and give us a call if you would like to go ahead and get that on the books. As always, 800-928 4001. So thank you. Have a great weekend.